Hi guys, this is Roni here. So, today I will discuss about the financial management. Let's get started. Topics to be covered is introduction, finance related discipline, finance under micro and macroeconomics. I am starting from introduction of financial management. Let's have a look on the definition. So the definition is financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. Here the procurement means collection and utilization means desirable or best possible. So, the whole meaning is says that collect the funds of company and use it in best possible manner. And then it says that it means applying general management principle to financial resources of the enterprise. It was all about the definition of this. Let's move to the next topic, that is finance and economics. Microeconomics is concerned with the institutional structure of the banking system, money and capital markets, financial intermediaries, monetary credit and fiscal policies and economic policies. Since businesses operate in the macroeconomics environment, it is important for the financial manager to understand the broad economic environment. Here capital markets includes stocks, bonds and other forms of long-term capital. Financial intermediaries includes commercial banks, investment banks, stock brokers, insurance and pension funds, pooled investment funds, leasing companies and stock exchanges. Basically, financial intermediaries means an institution for individual that serves as a middleman among diverse parties in order to facilitate financial transaction. And you may know that fiscal policies makes by government and monetary policy makes by central bank, if you say in India that is RBI. Features of financial management. Manages the financial resources. It means efficiently manage the funds of company. Properly utilize all funds. Properly use the funds of company. It includes how to invest, where to invest, how much to invest and when to invest. That's it. Continuous function. Lower the risk. Continuous process. Facilitates cost control. It helps the company to manage the cost properly in efficient manner. The next topic is in macroeconomics, the factors that a finance manager should look upon. So the points are: recognize and understand how monetary policy affects the cost and availability of funds. In India, RBI increase or decrease the repo rate and reserve rate of bank to control the economy. Be versed in fiscal policy and its effect on economy. In any country's government makes expansionary policies and contractionary policies to control economy. Be aware of the various financial institution financing outlets. Understand the consequences of various levels of economic activity and change in economic policy for their decision environments and so on. It's obvious that tax rate, government spendings, repo rate and reserve rate affects the economic environment. In microeconomics, the factors that a finance manager should look upon. Microeconomics provide for effective operations of business firms. A manager need to do detailed study on the following points based on microeconomics environment. Here are the points that are: supply and demand relationships and profit maximization strategies. The law of supply and demand predicts that if the supply of goods and services outstrips demand, prices will fall. If demand exceeds supply, price will rise. In a free market, the equilibrium price is the price at which the supply exactly matches the demand. Issues related to the mix of productive factors, optimal, sales level and productive pricing strategies. Some pricing strategies are cost-plus pricing, skimming, penetration, demand-based and competitive pricing, measurement of utility preference risk, and determination of value. The rationale of depreciating assets. So, the additional topics is marginal analysis. So, let's dive into definition of this. It suggests that financial decisions should be made on the basis of comparison of marginal revenue and marginal cost. Such decision will lead to an increase in profits of the firm. Marginal analysis is the process of breaking down a decision into a series of yes or no decisions. More formally, it is an examination of the additional benefits of an activity compared to the additional cost incurred by that same activity. So guys, this was all about the today's topics. We'll see you my next video. Think wisely and do properly.